Investing is one of the greatest tools average Americans have to build long-term wealth. The power of compound growth allows money invested to grow exponentially over decades. For example, $10,000 invested at 8% annual returns becomes over $100,000 in 30 years. Yet shockingly, nearly half of Americans have no money invested in the stock market. The wealthy know investing is a pathway to prosperity. Billionaires like Warren Buffett credit long-term investing as key to their fortunes. So why do so many ordinary people miss out on the power of investing to grow their money? That's why the wisdom of investing guru Jim Cramer is so valuable. For over 30 years, Cramer has helped countless average investors build wealth. Now, let's listen to some of Cramer's top tips for investing beginners. Here's his guidance on knowing yourself as an investor.
First and foremost, when you're managing your own money, before any other consideration, you need to know yourself. I've said this before, I'll keep saying it because it's so important. You simply can't know which stocks you should buy if you haven't taken the time to really consider what your own personal objectives are, and I can't decide them.
Many new investors make poor decisions by jumping in too quickly without clarifying their goals. Taking time to establish your timeline, assets required, and risk tolerance is crucial. Write down your specific financial goals and target amounts to save and invest. Self-knowledge is the foundation for smart investing. Don't just blindly throw money at the market. Carefully consider your needs and objectives first. This self-reflection lays the groundwork for crafting an optimal investment strategy. Be honest with yourself about your risk appetite and time horizon for different investment pools. Periodically revisit your goals and adjust your strategies over time as your situation evolves. Next, Cramer talks about using index funds when you're just starting out.
For those of you who don't have time to research individual stocks, you can't really go wrong with a basic low-cost S&P 500 index fund that tries to mimic the performance of the broader market. Look, I've recommended index funds endlessly here, and I'm going to keep doing it because they are phenomenal. At their best, they help democratize the incredible engine of wealth creation that is the U.S. stock market.
Cramer recommends index funds as an ideal starting point for novices. They provide diversification and minimize risks compared to picking individual stocks. Index funds allow hands-off investing without needing to be experts at evaluating companies. Even legendary investors like Warren Buffett praise index funds for regular folks. Open an account with any major brokerage firm like Fidelity or Charles Schwab, and you can start investing in an index fund within minutes. It's that easy to begin. To make it even easier, just start with small automatic monthly contributions. Stick to broad market index funds while you are learning and ramp up from there. Index funds offer easy, instant diversification that's ideal for beginners. Don't try to time the market. Stay invested consistently month after month. Think long-term. Decades of regular index fund investing can grow your wealth exponentially. Moving on, here's Cramer's advice about having multiple investment buckets.
You can have multiple objectives. You can and should have multiple pools of money. I like to break things up into your retirement portfolio, where you need to be pretty cautious, and your discretionary mad money portfolio, the extra money that you're not going to need in order to support yourself after late-stage capitalism has ground you down and you're no longer able to work.
Cramer suggests having separate pools of money tailored to different financial objectives. Conservative retirement money in index funds, plus mad money for higher risk and reward speculative stocks. This contains risks instead of jeopardizing your entire portfolio. Follow this advice by opening accounts for different goals, retirement, speculative, and so on. Know the purpose of each money pool. Don't mix all your money together. Divide it strategically based on timeline, risk tolerance, and goals for each portion. Remember to review asset allocation regularly. You may need to rebalance as goals shift over time. Don't let short-term speculative bets jeopardize your long-term nest egg. Additionally, Cramer weighs in on how to handle money needed for big future expenses.
If you want to pay for a house, you want to send your kids to college, you should take a more conservative approach to managing that money. Whatever kind of account you put it in, your strategy for college tuition savings or future house savings should look more like your retirement portfolio than that mad money portfolio.
Cramer advises taking a conservative approach with money needed for major future expenses. Don't invest emergency funds or down payments aggressively. Losing vital savings for necessary purchases through risky investing can severely derail life plans. Use conservative vehicles like bonds and CDs for these essential money pools. Don't gamble with funds for needs. Remember, investing emergency or short-term money should focus on preserving capital, not chasing high returns. Build up a cash reserve so you don't need to tap invested assets unexpectedly. Shorter-term savings should be parked safely. Don't mix essential funds with long-term investments. There you have it. Key investing tenets from the esteemed Jim Cramer. Clarifying your goals, using index funds, separating objectives, and matching investments to needs can help any beginner invest successfully. Let me know in the comments what investing tips from Jim Cramer have helped you. If you enjoyed this video, please hit the like button and subscribe to my channel for more investing tips. Your support helps me continue creating content to help others build wealth. Thanks for watching.